Hello my friends, welcome back to my YouTube channel. Don't forget to subscribe, like, and share this video. In this video, I will share about understanding and reading the candle pattern in our trading. Those of us who are in the trading world certainly understand the existence of various types of charts in a platform. This chart presents fluctuating market price information. This movement will appear in the form of ups and downs of the graph. This data is useful for conducting technical analysis of market prices. There are different types of charts that traders use. For example, candlestick charts are a favorite of trade. The following is the understanding of candles that we need to know as traders. The use of candlestick diagrams first appeared in Japan. The accuracy rate is considered the best than other charts. This form of chart is growing in popularity among traders. Candlesticks represent the impact of investor sentiment on stock prices. Analysis like this is useful for investors to determine the right time to trade. This method helps analyze a number of financial assets, such as stocks, cryptocurrencies, and forex. The use of candlestick charts falls into the category of discretionary methods. That is, candlesticks use subjective intuition. The first is the body candle. The body candle is the part that presents the price, opening, and closing. It looks like what you are in this video. The second is the shadow candle. Shadow candles are in the form of lines that stretch above or below the body. The color follows the body candle. This section indicates the lowest and highest prices of the market. Next is what we must know, namely, the type of candlestick pattern. Several types of candlestick patterns usually appear to analyze market price fluctuations. These patterns are used to determine market transactions. And this is the type of candlestick pattern that we must know as a trader. Hammer is a bullish reversal pattern that forms in a downtrend. When the price is falling, the hammer pattern shows the lower limit is near and the price will rise again. Inverted hammer is a candlestick pattern that indicates the potential for price reversal from down to up in a market. Hanging man pattern is a reversal pattern from bullish to bearish. In this pattern, it appears that the length of the tail is double the length of the body and is in an uptrend position. The shooting star pattern is a reversal from an uptrend towards a downtrend. The condition of this pattern is that the length of the tail must be double the length of the body and be in an uptrend position. The spinning top candle is one of the candlestick patterns that can signal a reversal of the trend direction. By analyzing the spinning top candle at the end of a trend, you can make it a reference to achieve profit. A doji is a candlestick formed when the opening and closing prices are almost the same for some time. Doji candle is one of the candles that are quite well known by traders. Because this candle often provides information to us about the reversal of a trend. The morning star shows a reversal pattern from an uptrend towards a downtrend. There are three candle formations. The first is a bearish trend that is greater than the second candle, namely spinning tops. This pattern indicates a reversal from bullish to bearish. The evening star is the opposite of the morning star. The main tree of this candle formation is a small-bodied candle or doji that slips from the previous candle. In fact, instead of memorizing the evening star or morning star pattern formations, it is better to understand the background of why both patterns formed on the chart. Because under special conditions, the formation may be formed imperfectly or slightly off, but the signal is still worth considering. To make a candlestick, data is needed from the values at the opening, highest, lowest, and closing prices, commonly called OHLC, opening, high, low, closing. Data from OHLC is a guideline for analyzing a candlestick. The data will display a visual image that can be understood and read for analytical purposes. The convenience offered is that decision-making can be done at a glance. At a glance, we can see if the price, when it closes, strengthens or decreases.